Hello, everybody. Joe Lucey here, Secure Retirement Financial. And joining me today, I've got Tony Shink, institutional. Uh, Tony, help me out. What's your title there?
Institutional director.
Institutional director with Minneapolis Portfolio Management Group. I know a lot of you have been are aware of Minneapolis Portfolio Management Group. Some of you have never heard of them. That's great. They're a good partner of us here at Secured Retirement Financial. And thought it was a good idea, good timing here with everything going on. Let's kind of get an update here for this week's Market Huddle with Tony Shink. So, Tony, welcome to Joe's Market Huddle this week.
Yeah, I appreciate the invite and look forward to chatting with you virtually as well as everybody else on the call.
All right, so what we'll do here is I'm going to go ahead and start up a slideshow. Tony has some things put together here, and then I'll probably kind of duck out of this, let Tony kind of take over, and then the two of us will be available after a bit here to answer anybody's questions. So if you haven't attended one of these in the past, if you just go to the chat, there's a little area there that you can type in your question. Good morning, Tim, Chris, Jay, Sharon. So just kind of plug in there and we'll make sure we address them. We'll probably go through the presentation, then make sure we answer any questions. Ideally, probably about 15, 20 minutes for the more formal piece here. And then we probably have another 15 minutes or maybe 10 minutes of answering any questions anybody has. And so anyways, welcome everybody here to my Market Huddle here on August 3rd. Can you believe it's already August 3rd? Wow. Anyways, so here's the disclaimer that my attorneys make us say. Understand we're going to be talking about things like, or potentially we might talk about taxes and income planning and estate planning, things like that. I'm not an attorney. I'm not a CPA. Also, any of the discussion we have today regarding investments are forward-looking. We can't necessarily, returns and such can be different than different things. So anyways, with that said, Tony, I am going to get out of your way and let you go ahead and talk here for a little bit, and then I'll be around and make sure that I help Tony with any kind of questions anybody has. So without any further ado, welcome, Tony Shink.
Great. Well, I really appreciate it, Joe. Always a pleasure to be working with you and your team. I figured today, given what the markets have been up to, it makes some sense to just kind of give a really quick overview of who MPMG is and how we manage money, and talk a little bit about what has been happening over the last couple of months here. So Minneapolis Portfolio Management Group is a long-only value-based equity firm. In other words, we work to locate great companies whose stock is inefficiently priced and then hold on to them for 4 to 6 years on average, and then sell them off, hopefully to the eager, once we feel that these stocks are fairly valued. And then we just repeat that process over and over. We have been doing this investment strategy or value-based strategy for quite a few years, 25 years now. We have a GIPS compliant track record, or as I like to tell people, we have the Good Housekeeping seal of approval on our numbers that go back over 2.5 decades. We manage about $1 billion of assets for individuals, families, and institutions. And we, like I said, try to locate great companies that are inefficiently priced and then hold on to them until we feel that they are fairly priced. And typically, this has been a relatively tax-efficient way of creating wealth for our clients over time. We're consistently highly ranked. And for those individuals that were fortunate enough to invest with us way back when we started in 1995, $1 million invested back then would have grown to over $13 million today, which is about 23-24% greater than had somebody just invested in the S&P 500. And if they had invested in a value type of index, like the Russell 3000 value, we have had a very strong overperformance of nearly 50%, 49% over the Russell value indices over the same time period. Not to say that that will continue. However, this process has been honed over multiple decades of real life experience. But unfortunately for investors or anyone else putting money into the market, it's not always a straight upward trend. During those 25 years that we have been investing money for our clients as well as ourselves and families, we've had to deal with many bumps in the road, such as the Asian contagion way back in the late 90s to the dot-coms that we all remember, and most recently the financial crisis. And now we're maneuvering through the coronavirus. Now, typically, there's a couple ways to invest in the market. You can either have a growth trend, a leaning investment ideology, or you can invest more towards value, which is what we have our expertise in. Now, growth investing is typically defined as looking for companies that typically are growing at a much faster rate than the general market, and their stocks are pretty much priced for perfection, if you will, going forward. Whereas value investors, such as Minneapolis Portfolio Management Group, we are not looking for cheap companies. We're looking for great companies whose stock prices and valuations don't represent what we feel are the true price of these great companies, these iconic businesses that we've been investing for our clients. Or another way to look at this is that value is kind of like purchasing a pre-owned house that needs a little work that has great potential in an established neighborhood, versus growth, which is paying more, if you will, for a brand new house that has never been lived in an up and coming area. Now, if you take a look, when one is investing, these two strategies really shine in one point or other during the cycles of the market. Growth stocks, which have been doing very well recently, they have the potential to perform better when interest rates are falling and company earnings are rising. However, these businesses are also likely to be the first ones to be punished when the economy is starting to cool, or as many look at it as recessions. Whereas value stocks are often stocks of companies that are cyclical industries in nature and do very well typically and historically when an economy is growing out of a recession and is starting to level off and start to improve. So now if you take a look at what we've been experiencing over the last couple of quarters here, the first half of the year, we were in a position where the general markets and the global economy took a very quick and rapid hit to growth, and actually saw a contraction in the first quarter, which was very quick and very painful. You saw the S&P 500 drop nearly 20%. It hit its lows towards the end of March when it was down almost 35%, if I remember properly. Now, what's interesting is that the following quarter, after March, we started to see a pretty quick return and rebound in the markets, where the second quarter was one of the strongest quarters we have experienced in investing, at least since the late 1980s. Now, what I find very interesting is that when you take a look over the first half of the year, the S&P 500 is down only 3%, and that's capitalized weighted, which means that the largest companies really are pulling the market up versus the rest of the 500 businesses in the S&P 500. Because when you look at the S&P 500 equal weighted index, when all 500 companies are equally weighted about 0.2%, you will notice that the S&P 500 equal weighted index is still down about almost 10.5–11% year to date, with without weighting the Microsofts, the Apples, and the Amazons that have very high valuations and are basically priced to perfection. Now, the question is, when you take a look at where we are in the market cycle, over the last 14 recessions during the last 90 years through 2019, most of the time during a recovery, cyclicals have historically outperformed other type of investments in the equity markets, about 67% of the time. So if you take a look at what is the difference between the cyclical and defensive, you will see several of these different market sectors: consumer discretionaries, technology, industry, and defensive names like healthcare or areas such as utilities. Now, our portfolio and how it's positioned, you will see, is heavily weighted towards cyclicals. These are great, iconic businesses, companies that we have invested in for decades and decades, that have done very well for clients over time. Now, recently, on the last call that I was fortunate enough to be on with your company, we had talked about a couple of our newest holdings, Starbucks and Disney. Both of those businesses we had purchased right at the end of first quarter, and now they're up over 15% since we purchased them. Not to say that they will continue to do well, but we do believe that these businesses are priced at very attractive valuations and will hopefully continue to provide great opportunities for our clients going forward. And most recently, we have added a couple of unique names, businesses that we might want to talk about, such as Pfizer and Cisco, the food delivery company, that have been put into our portfolio over the last month and a half. Now, the question you really have to ask yourself while investing is, do you want to be investing in what is working today or what will likely be working tomorrow in the years to come? And we feel, based on history and some of the valuations of these great businesses, that the place to be are these companies that are just starting to come alive, businesses such as Pfizer and Cisco. And with that, I will open it up to any questions that you may have. I know that there were several questions that were asked beforehand, and I would like to be available for anything that might come about on the chat feature. You there, Joe? Well, I appreciate the time.
I gotta unmute. Hold on, I'm
there
good.
We go.
Okay, so does anybody have any questions? Here's one that I've been getting a little bit more recently, Tony. You know, you have a position in Boeing. Everybody knows that Boeing is heavy in the airline industry. It's a company that has probably, or it's an industry, an area sector that's been definitely impacted substantially by COVID. What are your thoughts on Boeing? Why are you owning Boeing and continue to own it? And it's down. And so what are your plans for it going forward?
So Boeing is an interesting business. They are our country's largest exporter. What many people forget about Boeing is that 40% of their revenues come from defense. Now, even though we are experiencing some real issues right now with their 737 MAX commercial planes, and those birds, if you will, are still not in the air, we believe that Boeing, as, like I said, one of our largest exporters, or the largest exporter, it's highly unlikely that our federal government and the local governments that have Boeing plants in them are going to not work with Boeing to have this company be a success. In fact, when you take a look at Boeing right now, over the last month, they just acquired a contract for nearly $25 billion of new F-15 fighters, I believe it is, for our military. And we continue to believe that this company will be fine. It's going to take a little time, but we are sticking with our conviction and our belief that Boeing is one of our really only major manufacturer of airplanes, will work itself through these programs or through the difficulties they've had, and we'll see the 737 MAXs back in the air. And when you take a look at the amount of additional airplanes that we're going to need globally over projections over the next several decades, it is highly unlikely that Boeing will not end up being a success. It's just a matter of patience and staying true to this company.
Okay. Does anybody else have any questions? One I'm also hearing a lot right now, Tony, has to do is concerns about the election. Whether you are planning on voting with the current administration, against the current administration. Definitely something that a lot of people have got front and center. That and COVID has kind of taken over probably what I think we're going to be talking a lot about over the next 6 months. So tell me what MPMG is doing right now as far as either addressing or any kind of opportunities or risks you see with the election, any opportunities or risks you see around COVID and continuing, and what have you.
When it comes to the election, really, in our belief, it comes down to two things, and that is how is the occupant of the White House going to affect taxes and regulation. One of the interesting things that might be happening today because of the coronavirus and the COVID pandemic is that it might actually benefit the economy and the markets in the midterm. And what I mean by that is because the economy is so fragile right now, regardless if we have the current occupant continue to go in for the next 4 years or a new occupant, it's likely that we're not going to see a whole lot of changes going on with tax policy or regulation until our economy is on stronger footing, which may actually help and benefit us going forward. Now, what are we personally doing with our portfolio today to be positioned for the coronavirus and the economy? Our newest position, which is Pfizer, is one of the companies that is out there that likely has a potential vaccine. Things are still very early to know if there is going to be a vaccine that works or what type of a pharmacological solution are we going to have going forward. It seems like every day or at least every week we're seeing new advances going on. Now with Pfizer, they're in phase 2 trials, and we think that this is a very unique way of playing the coronavirus on a couple fronts. One is that they have the vaccine, and two, there's only a few companies out there that have the production abilities and the distribution abilities that will be able to provide or administer a vaccine or pharmacological solution when it comes to taking care of this coronavirus. Pfizer, when we first started buying it, was trading in the mid 30s. It has a PE of just under 12 and a 4.5% dividend. So we think that this is a very unique opportunity to get into a fabulous world-class company at attractive valuations, and will likely have our clients benefit as we move forward with the coronavirus vaccine or solution. One of the other things that we've done is we picked up Cisco, the food delivery company. As everyone is concerned about seeing the hospitals being closed down, the schools being shut down, as well as restaurants taking a huge change to their environment. We look at this as an opportunity to get a company that's giving us about a 3% dividend, and they have done a really solid job of reducing their costs. They are actually putting away quite a bit of money. Right now, I believe they have $300 million in cash on their balance sheet that they will use for one, paying their dividend, make sure that their operations are moving seamlessly without any problems. And this is the kicker that we're excited about with Cisco, is that as we start to learn how to play in this new environment, that Cisco will likely be increasing their footprint, either buying some of their smaller competitors that do not have the cash ability to work in this environment, maneuver with a change in the hospitality and service industries, while increasing their delivery and output for Cisco and their investors. So we think that over the next, who knows, 4 to 6 years, that Cisco will be a very interesting play given this new environment that we're living in.
So I hope that answers or helps answers Tim's question about investing in food service. Maybe touch real briefly on retail. I know you've got Tractor Supply, I believe, still. And what are some of the retail names, type?
Actually, we do not have, we sold out a Tractor Supply. It was a phenomenal investment for our clients. We were very pleased at how it did. However, when we look forward, we just felt that the growth opportunities at Tractor Supply did not justify the valuation, so we exited out of that. However, we still are investing in companies like Nintendo and Sony that are doing very well with the quarantine, if you will, or with not as many people out and about these days. So we continue to have those names in our portfolio. Starbucks is doing well, which is kind of a retail play. Which is interesting with Starbucks is that when you look at McDonald's or Burger King, people regularly go to these companies. However, Starbucks, their loyal consumers will go there about 16 times a month. So they have a very, very strong foundation of individuals or loyal consumers. We also picked up Walt Disney that we think will do very well going forward in the commercial world. Newell Brands, which you've probably never heard of. You may have heard of Newell Rubbermaid, the containers that they make. But Newell also owns products like Elmer's Glue. And with the fact that there's not too many things to do today, Newell is starting to pick up because they have a very strong camping division. And their Contigo cups, as an example of hot and cold containers. So Newell, which is starting to turn itself around, we think has some great opportunities with some of their unique brands that they have.
So in other words, I think that part of the answer to Tim's question is in every crisis, there's still opportunities, and there are some opportunities within food service and retail. Let's move on here and kind of maybe so Sharon is asking about what's your research process, and at the same time you start answering that, I'm going to go ahead and pull back up that PowerPoint that talks about answering Jay's question regarding portfolio performance that I'll let you address right after Sharon. So why don't you start with Sharon, and I'll pull up the PowerPoint here at the same time.
Well, the first thing that we really like to do is just take a look and see what's out there, Sharon. How many publicly available companies are there? And there are thousands and thousands of these businesses that we can look at any time. So the first thing we really want to do, though, is to take a look and understand what the market risks are. You could say that a company whose stock has gone from $60 a share down to 10, a lot of that market risk has been lessened. But instead of using a raw price, we use valuations or matrices, such as things like price to sales, price to book, price to cash flow, to try to give us a little stronger understanding of if this company is cheap compared to itself historically, as well as its industry historically, as well as today. Then what we want to do is really start rolling up our sleeves, understanding what the business risks are of these individual companies. Now, in our business, in investing, a lot of people love going to the income statement because that's what drives this industry. It is sexy what a company is going to make over the next 6 months or a year. However, we're buying companies that have oftentimes, they've tripped. They've fallen out of the graces of Wall Street. So what we want to do is really look on the flip side, which is the balance sheet. Do these companies have solid assets? Do they have little to no debt, positive cash flow? And really important for us is, are they a leader in their industry? Now, if all we did was look for cheap companies with strong financials, we could fall into what's called the proverbial value trap and basically buy companies that just kind of sit there and don't do anything. So we also like to find or try to locate are companies that have a catalyst, that are something there that's going to propel them to their next level. And then we evaluate and continue to search these companies and see if what's in our portfolio is always the fastest horse, if you will. I hope that answers the question. If not, we can always do a follow-up.
Well, yeah, well, you bring that up. If anybody's on the call would like a 15-minute call with a 15 to 30-minute call with one of our advisors, one of our team members, myself, or even with Tony, we're going to make sure that everybody gets an opportunity to do that. In fact, I have an offer I'm going to put up here, and it's I noticed before I do this here, it talks about a look-forward tax analysis, but this will schedule a 15 to 30-minute phone call on our calendars. And if you click that, even though it says tax analysis, we'll just make sure we address this week's topic on my Market Huddle, working with Tony, and we can schedule a time either to directly ask questions about your own portfolio with Tony, ask questions about our team and what have you. So, Tony, I also have here a slide that we went through, and we probably zipped through this a little quick. And a couple things I wanted to point out before you jump in here. Number one, if you look at the footnote, it says all ACV composite performance are net of fees. So the ACV is the all cap value portfolio that we have with MPMG, Minneapolis Portfolio Management Group. And it says it's net of fees. So after expenses, what fees are they using there? Because I know that some of our different clients might have different fee structures for a variety of reasons. But what are the fees that you're using in your numbers here?
Oh, sure. We use actual MPMG's fees paid by the client. It is time weighted and size weighted. So it's a weighted average of what our clients are paying. It ends up being around 1.5%. I don't have an exact hard number for you, because a client who has a $50 million account is going to be paying less, if you will, than somebody who has a $100,000 account in it. But on average, it's about 1.5% is the fee that is being worked into that. But if you look at the actual footnotes, it gives you a better description.
Okay, so going into Jay's question, how have you done year to date? You're the top there, that down 10.13%. And then the other two are really more about value indices. How are you doing versus other value companies or value portfolios? And you're doing substantially better, down 10% versus 16. It's still down, but down a lot less. And then I see two different S&P 500 numbers there, and that gets confusing sometimes, Tony. So if we're looking at your negative 10%, should I be comparing that to the negative 3% that you've got there for the S&P 500 TR, or the negative 10.77, which is along the same lines as the S&P 500 equal weight? What's the difference here?
The big difference with the S&P 500 TR total return is that it's capitalization weighted, which means that the largest companies are giving the largest push of performance. Could be positive, could be negative. Right now it's positive. When you look at the Microsofts, the Apples, the Amazons, Facebooks, they now account for about 25% of the entire capitalization of the S&P 500. In other words, if you bought every last share of those companies, that would be their entire capitalization. Or what, if you could write out a check, if a company had a capitalization of 100 million and you wrote out a check for $100 million, you would own every last share of that business. Now, if you take a look at the S&P 500, they're taking the capitalization or the value, if you wanted to buy all 500 companies and put that together. Microsoft, Apple, and Amazon, Facebook, those companies now account for, like I said, about 25% or 1/4 of the entire S&P 500. So they are really pulling up the S&P 500. Now, what's somewhat interesting is that they're priced for perfection. They are, as an example, Microsoft is at a 37 multiple. In other words, people today are willing to pay 37 times what they expect Microsoft to be earning next year. The S&P 500 historically trades somewhere between 16 and 18 times next year's earnings. So those companies are priced very, very expensively today. And when you take a look at all the other companies in the S&P 500 and the businesses that MPMG looks to invest in, these companies are priced at a lot more attractive or reasonable valuations today. And if you're looking at investing for the long term and not only hopefully protecting your money, but growing it over time, the cheaper and more attractive valuations are going to benefit you. Now, if you take a look at year-to-date performance, getting back to how things have been going, the S&P 500 equal weighted index gives you a better or more realistic picture of how the general economy is looking throughout the U.S., which is down to around 10.5% or 10.77% through second quarter. Today, actually, up through August 3rd or thereabout, the markets have definitely improved even from those levels. And the S&P 500 is flat to slightly positive, whereas the Russell indices are down around 13%. And MPMG, our all-cap value strategy, is down about 5.5% up till August. So things continue to improve, and a lot of our businesses are turning around very quickly.
So if you have additional questions, in other words, what you're saying is you've been doing about as well as the rest of the markets, as long as we aren't overweighting the top 5 to 10 positions of the S&P. So with that said, if you have any questions on that, make sure you click that link, schedule some time. Let's visit. I know it says look forward tax analysis, but we can discuss anything that's important to you on that call. The idea of the call is just to identify the number one action step you can do right now to make sure that your portfolio is on track or can be improved. And if that's around performance or results around S&P 500 or Minneapolis Portfolio Management Group, let's go ahead and do that. Finally, Tony, in about 2 minutes or less, let's address Mark's question here. I know that we're gone a little bit over here today, so I apologize, and hopefully you can stay with us. But Mark is asking about, why aren't we moving in and out of cash and what have you? What's the shorter version on that? And then if you have additional questions or if you've got a question similar to Mark's, go ahead and click that the offer there and make sure you schedule some time with us. But go ahead, Tony. What is the reason why we are not moving in and out of cash?
If we had a perfect understanding of what the markets are going to do, it would be a great thing to be able to move in and out of cash. However, your taxes would be significant, and we would be doing extremely well. But things are cloudy, and nobody knows for sure exactly what's going to happen from day to day. And a lot of times, like the businesses we invest in, are ugly ducklings that are turning themselves around or becoming those swans, but it takes time. And to really get the full benefit of these businesses and the hopefully wealth creation, if we're correct on holding these businesses, it's going to take 4 or 6 years, and we would much rather add to these positions on a temporary basis when the markets are down. It's interesting because the markets really trade on 2 different frequencies, if you will. On the short term, they bounce day to day. They're very inefficient based on whatever the news of the day is, what's going on geopolitically, macro events that are happening, health, all of these things will move the market very temporarily. On the long term, though, and this is where we invested, it's the company's ability to generate earnings. And if we can find great companies whose financials are really strong, that have consistent earnings, our clients are going to be better off, and they're going to have a much more tax efficient return over the long term. as opposed to trying to basically play the market like you're playing roulette?
I think that's a fair answer. My shorter answer, my response, I oftentimes will share, and I'll share this with Mark if it's okay with you, Tony, is
Sure.
if we sell out of the market, we got to be right twice. We got to sell it out and be able to buy it at a lower price. Think back to May 23rd. The market had just hit 18,500. We'd just been told that we weren't able to leave our homes. Everything looked about as dark as it was going to be. And that was the time that you would have had to purchase back in to get back in at the bottom. It's really hard to decide where the top is, where the bottom is. And as Tony was saying, for tax efficiency reasons and just churning of over the positions, usually it makes sense to buy good companies early on and then hold them long term. So that's the philosophy that MPMG has. We share that as well with MPMG, or Minneapolis Portfolio Group, here at Secure Retirement Financial. I can tell you, after working with literally thousands of clients, those that have increased the most wealth with stock market investing tend to be those that tend to buy and hold longer term investments instead of shorter term trading. So with that said, we have gone over our allotted time here today. I want to thank you, Tony, for joining us here today. Again, if you have any questions, if you're a current client or a prospective client, maybe you're just joining us for one of the first calls we've had, or maybe you've been watching in the wings and now's a good time, schedule 15 minutes. That's where the process can start, or it's how we can make sure that we're reviewing things with you, our client, for those of you that we aren't necessarily have the privilege of visiting with once a month. So if you have questions, please don't hesitate to reach out to us. You can use that link. You can call the office. Most of you have that number, 952-460-3260. And if you think that there's some value in this and you know somebody that you think can value from it as well, feel free to forward on we'll be getting out a replay of this, and you can forward this on, or maybe you had to catch it, come in late, or you had to leave early, whatever it is. We'll make sure that everybody has a copy of this, and you are welcome to share this with other families and friends that you think can benefit from that. With that said, that's all we have for this week's Market Huddle. I apologize for going a little bit over here today, but we'll be back next Monday, same time, right over the noon hour. And everybody have a great week. Have a good day. Bye-bye.
Thanks.